Most people think of investments as stocks and shares, or something that you need to buy from a bank or a stockbroker. It's not necessarily the case. I mean, if you're an entrepreneur and you put money into your own business, that's an investment. So, we have that famous saying, the return of investment, and that's exactly what it is. But for most people, if you're on PAYE or just in the job, your investment portfolio will generally be stocks and shares that are traded on the stock exchange. The reason for that is that they are liquid, i.e. you can sell and buy them pretty easily.
Do you reinvest your money immediately, or do you, put it into other assets or investments? What do you do there?
Here's the interesting thing. Most business owners that I know, successful business owners, will reinvest in themselves, i.e. into their business or into another business venture that they will start, primarily because they believe, and rightly or wrongly, it doesn't matter, that they can generate a better return than someone else can, right? Which, if you're a successful business owner, is a kind of a fair, let's call it a fair bias. It doesn't mean to say that you will generate more returns or not, because no one can say that. However, remember what an investment is. An investment is the basis of giving money to someone else to grow it. And basically what happens is that money goes into a company. Let's say I'm your investment manager, and I put it into a company that's listed on the stock exchange because I believe the management, or the people who are running that company, can distribute those funds in a way that makes the company more profitable, which will give us a better return or higher share price. So you make money on it. And that's the basis of it. So as a business owner, a lot of them say, hang on, I can actually distribute and manage that money more effectively within my business or another business that I'll start, and I get a better return, and and that's perfectly okay. And you can't talk about risk without mentioning diversification. And for a lot of people, they hear this word diversification, they might kind of think they know what it is, and they probably do. But diversification is basically spreading your investments over a wide variety of asset classes to manage the risk of that portfolio, because no one knows if equities are going to go up tomorrow, or property is going to go up tomorrow, or bonds are going to go up tomorrow, or no one knows how that's going to be. So what we do is we spread it around. And how this works, I'll get a little technical, so jump in, Tim, and stop me as you usually do, because I start rambling on, right?
Awesome.
So when we look at investment, we look at, there's two primary bits of information we look at, and we use the Greek letters for this. So we look at what's called alpha, and we look at what's called beta. Now, alpha is the amount of return that a fund manager gets over and above the market return or their benchmark. So I'll break that down a little bit, because if I'm an equity portfolio manager, and so I've got a portfolio of, let's say, mainly UK equities or traded shares, I have a benchmark against what I need to perform, right? So how am I performing relative to something else? And for this example, let's say it's the FTSE index, right? FTSE 100, because I've got many large corporations and that kind of works. So I need to have a positive alpha. Basically, the FTSE does a 5% return in a year, and I do a 7% return in a year. My alpha is 2%. Okay?
I know what you're talking about. I studied it a while back as well. It's a graph of your risk averseness and how much you have in terms of your capital, or how much cash flow you have, right?
Increase in wealth isn't proportionate to increase in happiness, basically. We kind of know that, right? Above a certain point, you've got to get to a point first.
I'm gonna kind of argue with you on that, though. I read this, and I didn't read, but I actually watched this documentary again on this real estate broker. The guy is basically, he does a ton of real estate. He does a ton of insurance in the US, in New York. His name is John Henry Stiles, and he talks about how the $70,000 a year is the tipping point of where, you know, people stop getting happy in proportion to how much they earn. And because we do know that, I mean, when you're talking about class,
that's my point, right?
Yeah. So he talks about $70,000 a year, and till you get to that point, you know, you're doing what you have to do. It's after that, you know, depending on everyone's lifestyle, everyone has their own particular style in terms of what they want to live, vacations, you know, clothes, cars, houses. But that's when you start worrying about, you know, your next meal kind of thing. You know, that was what I kind of took from it, because there are people, you know, living on a daily, you know, daily structure in terms of finances, and there are people living in generational financial, you know, literacy. So what's your take on that?
Now look, more money makes you happy up to a point. And that point is different for everyone. So when you are on the breadline, so to speak, or you're living hand to mouth, if you get to a situation where you're now living month to month, I mean, that's nirvana, right? You think that's happy, but then you move the goal again, and you move to year, and then you move the goal again. And for some people, you get to a point quite quickly. Let's say it's $70,000 a year, I don't know. And then it's okay, because more wealth then doesn't necessarily lead to greater happiness. So you save that money and invest it, and you secure your future. Or else you're someone else and you need $1 billion to have that feeling, right? Because that's how billionaires are created. They need to just keep going and going and going. And some don't stop. But for most of us, it generally holds true. Once you get to a certain level, then the rest is just jam. And you know, people think, oh, but I'm going to buy a mansion, I'm going to buy a car, I'm going to buy an island, I'm going to buy a country. Well, you don't. No, you don't do that, right? Now, this is investment risk. So it's different to a person's risk or a person's willingness to take risk, okay? So that's the one risk category. Then we speak to people who are actually investing their money. A person's risk has two elements to it. They have the risk they're willing to take, i.e., you can ask someone, how do you feel about the market? Well, I'm pretty confident about it. I know what I'm doing. You know, I've read books or even I've been a professional investor. Okay, how do you feel about this pot of money, whether it's a pension or an ISA or another investment vehicle? How do you feel about that pot of money losing 10, 20, 30% in any given year? And this is different, right? Because for a pension, you may have 20, 30, 40 years till you retire. So that's okay. So, you know, in 1 year, I can take a 30% hit because we've got time to recover. But this ISA, I'm actually saving up for school fees, and I'm going to need it in 3 to 5 years. So no, I can't take that kind of hit because we don't have the time scale to make it up. So the time scale of the investment is very important to the willingness of the person to take a risk, right? And this is the risk of markets going up or down. And remember, if you've got everyone has this, okay? Everyone, no one has the expectation of getting more returns, or you might think that that's what they would have, but everyone has the aversion to loss. So rather than expecting greater returns, people expect less loss. That's the kind of psychological bias for people. So you've got to make sure that you limit that for them. And we can do that through diversification. We kind of can stick it in the corridor. Yes, it goes out now and again, but for most of the time, the math works. So then you talk to the person and say, okay, you're willing to kind of take this level of volatility, which we know. So if it goes, I know if someone can only tolerate a 10% downfall, then they're not going to participate in all the upside of the market, because we have to use asset classes to protect that, which will then dampen the upside, right? Makes sense. Yeah. So you have this corridor. Then I look at the person's capacity for loss. Now, this is the second part of the risk equation. So the first part of the risk equation is how willing are they to take the risk, and what is the time scale for that risk, right? And then the capacity for loss has another look. It says, okay, I know what you're willing or you want to do, and I know what you want to achieve, and I know the time scale you want it in, but can you actually do it? I.e., what are your assets in the background? What is your background? How stable is your job? How stable is your home life? And all of that kind of useful information. Because let's say you say, look, I'm high risk because I'm 25 years old. I'm investing into an ISA, and I've also got my pension. But you don't have a stable job. You don't have a stable income, and you may rely on this money sooner than you expect. We may notch you down a couple of risk levels. Just say, you know what? Let's just be a little cautious because your capacity for loss is a little bit low at the moment, and that can always change. But let's be a little cautious. Or can go the other way. Someone can say, look, I don't like risk. I don't want to take risk in the market. But their capacity for loss is actually quite high. So the money they're investing, it actually is not going to affect their lifestyle in any meaningful way, i.e. the way they live day to day, if they take a loss on this money. So we say, look, in order to achieve the goals you need, maybe we should get this risk up 1 or 2 notches. And people generally accept those discussions. We don't do a risk. And please, if you go to a financial advisor and he takes out a 1 to 10 bloody risk graph, just say, that's useless to me. You don't want that. You don't want to be scaled on a 1 low risk, 10 extreme risk, because that stops the conversation around it. It stops the meaningful conversation of how much risk you're willing to take. Do you know what the risk is? What is your time scale? And let's have a look at all your other assets and make sure that you can take the risk you want to, or you're taking enough risk you need to. And that's one point. So I don't use 1 to 10. I don't, we can say, okay, you're a medium risk at the end of it, or a high risk or a low, but yeah, so that's it. And then you can build a portfolio or stick them into a model portfolio, which is generally good if you've got a good investment management proposition at the back of you.